For this mock exercise, we're going to take a look at variance cost analysis using a company called Canadian Telecommunications Company. And I like this question because it's straightforward, and it's also a great way to showcase the journal entries that we need to record for these variance analysis. So let's take a look at the question. The question starts with, the company is a Singapore division of a Canadian telecommunications company, and they use a standard costing system for its machine-based production. And here's the data with regards to the production spent for the month of June. So, variable manufacturing overhead cost incurred, this will be actual. Variable manufacturing overhead allocated per standard, that would be the budget, the $14.40, that would be the budget. Fixed overhead cost incurred, that's actual. Fixed budget overhead budget, fixed manufacturing overhead budget, that would be the budget. Okay? So let me just put A beside for actuals. Now, the denominator level is machine hours, so that's what we're going to use to allocate. And standard machine hours per actual unit of output is 0.3. We're going to need that. Okay? Number of units of output is 49,200. Actual machine hours used is actuals again of 15,960. And there were no ending working progress. The question is, we need to prepare an analysis for all manufacturing overhead variance, and we're going to take a look at a 4 variance analysis framework. Then part 2 asks us to do a journal entry for manufacturing overhead without any explanation. And part 3 requires us to describe how an individual variance manufacturing overhead items are controlled from a day-to-day basis, and how our individual fixed manufacturing overheads are also controlled. So let's take a look at this question. So again, I like to solve my variance using a chart approach. So why don't I do that? Let me show you. So we're going to do just variable overhead first. So what was the actuals? That was given to us. The actual is 186,120. That was given. Okay. So what is the flexible budget? And by the way, the flexible budget equals the allocated amount, right? And so what is it? It's going to be actual output times budgeted input. So it's going to be actual output, the budgeted input times the budget price for the actual output. Okay, so how do we do this? What was the actual output? So we know that the units of output was 49,200. We know that the standard machine hours, which is what we're going to use to allocate the variable overhead, because it told us that the variable overhead machine hours was $14.40. So we're going to take 30% times 1440. That's the flexible budget, and that's also equal to the amount allocated. Now, we need to be able, so the difference between these two is what I called I guess it's the variable overhead, right? Variance. And the total of that would be a favorable variance of 26,424 favorable. Now, to understand how much related to efficiency and spending, we need to calculate a third column called actual input times budgeted rate. So what was the actual input? Well, we actually is 15,960 was the actual machine hours used. Times budgeted rate of 1440. That gives me 229,824. So now I can split this variant into these two. So first of all, the difference between actual and this number is 43,704 favorable, and this is what they call spending variance, or sometimes called rate variance. Okay? Because the actual input would have been the same in this case. And in fact, if we tried to calculate what that is, it would be 15,960 times the rate. And what's the rate? It's going to be 186, 120 divided by 15,960, $11.66 in comparison to $14.40. So this is why it's a favorable spending or rate variance. Here, you'll see that we've got a 17,280 unfavorable efficiency variance. Why? Because if you look at these two numbers, this is how many machine hours we should have used. This is how many we actually did use. So we have efficiency. Okay? Now, let's take a look at fixed overhead. Okay, I always start with actuals. And what was the actual? It was 481, 200. Okay? Now, what was the static budget? The static budget is 468. This is also equal to the flexible budget. So there's never a variance in these two. Now, we have a difference here, and this is called spending or rate variance. And that is 13,200 unfavorable. And by the way, this is also called flexible budget variance, right? Now, we would have changed the fixed and we would have allocated like a variable cost to each unit produced. So we would have allocated. Now, the key is that we need to figure out how do we get to the allocated rate? How do we get to the rate? How do we do that? Well, we know that how many units, so we've got the budgeted was 468. The denominator level is 15,600 per per machine hours. Okay, and we know that the standard unit of output is 0.3. So we need to calculate the rate. So it would be 468 divided by 15,600 to get to 30. So that would have been the rate. So I'm going to do the rate up here. And that would be, let me say that again, 468 divided by the denominator level of 15,600. That gives us $30. So what did we allocate? How many units did we actually produce? Output 49,200. How many machine hours? It would have been 30% times 30. This gives us 442,800. Now, the difference between 442,800 and 468 is what I call product volume variance. We end up allocating less than we should have. We should have allocated 468. We end up allocating less than that because our output was much less. And the sum of these two should be 38,400 unfavorable, and that's called the fixed overhead variance, which is the sum of flexible budget variance and product volume variance. Now, the second part of the question asks us, how do we control variable overhead? So control variable overhead, we need to identify what is driving the cost of the variable manufacturing overhead. So things like number of kilowatts of energy used, supplies used, repairs used. We need to control those type of charges that have no value to the units of output. So we're trying to minimize the amount of waste on supplies, for example. We're trying to also decrease the amount of repairs that we need to make. So that's how we would do that. So we look at what drives those costs, what are the main pieces that drive those costs, and we need to be able to control that. Now, in terms of, it says here, describe also how individual fixed overhead items can be controlled. That's a much tougher one to control because oftentimes these fixed costs are difficult to change in the short run. We can only possibly try to change it in a long-term period. And that's really part of it. The second part requires us to now journalize these variances. So maybe what I need to do is I need to set up what they call a 4 variance analysis. Okay, so I want to put variable overhead and fixed overhead. All I want to summarize the rate or spending. I want to analyze the efficiency and the product volume. So if I go back to the variable overhead, I can see that the spending variance is 43764. So I'll just write it down here. 704, I mean. That's a 0, by the way. Favorable. And favorable, because it's an expense, we know this will be a credit, right? And what about fixed overhead? What was our spending variance for fixed? It was 13,200 200 unfavorable, so we know this is a debit. Efficiency, if I look at the variable overhead, it was 17,280 unfavorable, and there's never a variance for product volume for variable overhead. And for efficiency, we know that there is, for fixed overhead, there is never a variance here, but we do have a product variance of 200 unfavorable. Now, normally if I ask you a 4 variance analysis, I'm looking for the split. If I'm asking you for a 3 variance analysis, all that would be is just adding the rate or spending variance together as 1. So you have that sum of this is 1 variance, 2, and 3. That's all it means. Okay? Now, we're going to actually do the journal entries as part 2 of the question. So the first part of the journal entry is we're going to record the actuals. So in this case, we're going to first record the 186, 120, the actual. So debit, variable manufacturing overhead. I'm going to call that control account. Credit accounts payable or cash. Two, we need to determine how much did we allocate to work in progress. It would have been the 212,544. That's the amount that we allocated. So we're going to debit work in progress. Credit variable manufacturing overhead allocated account. These are 2 separate accounts, by the way. Now, the third piece of it is I want to reverse out the control and the allocated account and record a variance analysis. So we're going to debit variable manufacturing overhead allocated. I'm going to credit the variable manufacturing overhead control account. Now, I want to record the variance analysis. So the first one is a favorable rate or spending. So I'm going to credit rate or spending. So I'm going to go variable manufacturing overhead spending. Variance, that's a credit of 43,704. And I'm going to debit variable manufacturing overhead efficiency variance. Again, the point of recording these entries is you want to track the efficiency of utilizing the cost. And I always remember that if it's unfavorable because we're dealing with a cost, that means you need to record as a debit. Okay? Now when we get to the fixed overhead, I go to the next page. First thing I'm going to do with fixed overhead is I need to record the actual. And the actual is this 481,200. I need to record that actual. So debit fixed manufacturing overhead control account. Credit accounts payable or cash or other accounts, whatever it is. It could be depreciation, accumulated depreciation. Remember, that's part of fixed overhead, isn't it? Now, what did I charge? I allocated 442,800 based on actual output. So I need to debit work in progress here. Now, there's going to be another entry which we're not showing here that moved from work in progress to finished goods along with direct material, direct labor. But we're not showing that here because that's not what's asked. and that is the allocation. Now I want to close out, debit the fixed manufacturing overhead allocated account. I want to credit the fixed manufacturing overhead control account. That closes those out. Now I want to record a variance. We saw from the chart earlier that the variance, we have an unfavorable of rate and unfavorable of product volume variance. Okay, so I'm going to debit fixed manufacturing overhead rate or spending variance, and I'm going to debit fixed manufacturing overhead product volume variance. And that should balance the entry. Okay, thank you.